Now speaking, Bill Staples, Chief Executive Officer. As a result, the growth rate in any quarter may be lumpy and difficult to predict. New Relic has the #1 platform for observability with a true consumption business model, the best customer success motion in the category, an industry-leading product roadmap, a strong balance sheet, and a healthy cash flow profile. I'm confident that we will continue to benefit from the secular tailwinds in our category and drive sustainable long-term growth and profitability. This statement summarizes the Q4 results and execution of publicly traded company New Relic. Despite economic uncertainty, inflation and market volatility, the company delivered consistent year-over-year revenue growth at the same 18% level as prior year. Over 80% of revenue came from its consumption business, growing 55% year-over-year, and 8-point gross margin improvement was achieved. With 57,000 actively engaged organizations, the company is the most ubiquitously adopted observability platform. Its growth engine and industry-leading rates allowed for head-to-head wins versus leading competitors, as customers focused on getting the best ROI for their observability investments. Customers have opened up room to expand their consumption as their business is ready, with 800 net new paid platform customers added in Q4 and larger commitments from existing customers. Innovations on the platform include generative AI, deep integration to market-leading APM capabilities and code stream for core coding languages, while cloud optimizations remain a fact of life in the short term. The company plans to accelerate its completion of subscription-based migration in the next 4 to 6 quarters and is confident in driving sustainable long-term growth and profitability. Now speaking, Dave Barter, Chief Financial Officer. The quarterly earnings call centered around New Relic's financial performance for the fourth quarter of fiscal year 2023, as well as their guidance for the first quarter and full year of fiscal year 2024. Revenue increased 18% from the same quarter 1 year prior to $242.5 million. Operating income was $26.1 million, representing a margin of 10.7%. Earnings per share was 42 cents on a diluted share count of 70.2 million. The company had approximately 12,000 customers on their consumption business model, up more than 35% from a year ago. Consumption represented more than 80% of their revenue in the quarter. Gross margin climbed to 79%, up 8 points compared to last year. They expect to invest approximately 25% of revenue in R&D, including the portion they're required to capitalize. For the first quarter of fiscal year 2024, they expect total revenue between $238 million and $240 million, representing growth of approximately 10% to 11%. They also expect non-GAAP income from operations between $26 million and $28 million. For the full year fiscal 2024, they expect total revenue between $1.02 billion and $1.03 billion, representing growth of approximately 10% to 11%. They also expect non-GAAP income from operations between $145 million and $155 million. The company is expecting improved profitability and cash flow in the coming year, due to cloud optimization initiatives and architectural enhancements, as well as product investment and sales investment plan for the coming year. They believe that increased growth margin, combined with sales and G&A efficiency, will lead to a meaningful improvement in profitability and durable double-digit margins. As of last week, they now have more than $425 million of cash equivalents and investments. They believe the business will continue to generate improving levels of free cash flow, expecting to generate free cash flow of approximately $150 million and end the fiscal year with approximately $500 million or more of cash equivalents, and investments. Baird analyst Rob Oliver inquired, "Can you provide some clarity on the factors that went into your top-line guidance for 24? What are the macroeconomic and churn factors, and what role did the product portfolio play?" Dave Barter replied, "Of your question, we've been pretty consistent with our guidance. We think that the impact from COVID-19 will be muted in comparison to other companies." Rob, thank you for the question. Our current assessment is that churn levels are expected to exceed what we have seen in the past. We anticipate that migrations will be clustered in Q2 and Q3, given our experience with business model transitions. Additionally, consumption trends on a day-to-day basis are monitored closely and cloud optimizations have been implemented. We believe our COVID-19 impacts will be minimal compared to other companies and, as such, we have kept our guidance consistent. Dave Barter replied, "Yes, I believe I have answered the first part of your question. Regarding product, we have seen strong uptake for our new product lines in both domestic and international markets. This reinforces our commitment to developing innovative products that meet customer needs. We are confident our product portfolio will continue to drive growth and market share for the foreseeable future. Dave Barter replied, "Yes, we are certainly excited about the potential of generative AI and other enhancements to our infrastructure and logs. However, we have not yet quantified what this could mean for our consumption revenue." Baird analyst Rob Oliver inquired, "Bill, could you elaborate on the trend of customers transitioning from initial landings to increasing usage? Are there usually any lags during this process as customers become more comfortable with the solution?" Bill Staples replied, "Good question, Rob. Our product and go-to-market teams have been prepping for our Analyst Day on Thursday to dive deeper into this topic. In brief, we've seen great success transitioning the business from subscription to consumption, unifying the platform's back-end and front-end, and growing a vibrant and engaged customer base. We monitor usage signals to connect customers with ISRs or enterprise sales teams, depending on their total opportunity, which can take anywhere from 1 to 2 quarters for some customers to several quarters for others." Canaccord Genuity analyst Kingsley Crane inquired, "Dave, how should we think about the cost associated with launching Grok?" Good afternoon. Could you please provide an overview of how Grok's generative AI technology is expected to impact the business in the near future? Specifically, how will it improve customer experience and what is the anticipated cost associated with its launch? Thank you. Bill Staples replied, "Generative AI is a hot topic right now, and New Relic is well positioned to take advantage of it. With our unified platform that can ingest and store all data types and data sources with just one API and one query language, customers who want to benefit from generative AI can easily do so by sending us more data. Our ability to be first to market with MLOps solutions, OpenAI GPT monitoring, and the Grok generative AI assistant shows how our unique platform model has allowed us to innovate quickly. Additionally, our business model is tailored to capture the expansion of data and engagement expected from generative AI, as we are priced on a user and data basis that allows for easy standardization while providing competitive costs. Our analysts event on Thursday will showcase how this technology works, and I encourage you to tune in." Canaccord Genuity analyst Kingsley Crane inquired, "Dave, based on the numbers we've seen, it looks like most of the growth in total revenue is due to conversions rather than consumption. Could you provide more insight into what the conversion rate from non-consumption to consumption will look like for the upcoming year?" Dave Barter replied, "Our subscription exit rate in Q4 was around 38 million, and we anticipate that it will decrease incrementally quarter over quarter. As people shift from subscription to consumption, there will be an initial period of optimization before growth occurs. Our expectation is that when excluding migrations, consumption will grow approximately 20%, with a margin of deviation of a few points. This is lower than last year's growth of around 30% during the same period, but still indicative of strong long-term growth potential." Dave Barter replied, "OpenTelemetry is an important part of our customers' technology stack, enabling them to create a more efficient and effective way to manage their applications. We are actively engaging with our customers to ensure they understand the value of OpenTelemetry and its potential for streamlining the management of their applications. Our competitors may not be as proactive in this space, but we believe that investing in OpenTelemetry provides the best value for our customers." Bill Staples replied, "You certainly can. We anticipate that customers will benefit from the cost savings of our Data Plus bundle, which offers a more attractive price point with the same level of high-quality performance and features. This bundle allows customers to purchase our most popular products in one package at a discounted rate. As many customers already use several New Relic products, this bundle provides them with a simple way to save money while also taking advantage of all the features they need. Additionally, as OpenTelemetry has become the de facto standard for cloud-native computing, we expect adoption of the Data Plus bundle to increase over time, resulting in further cost savings for customers." Dave Barter replied, "Yeah, it's a great question. The December renewal cohort was the first to benefit from price increases, and we saw that again in March. We anticipated a structural tailwind associated with continuing to capture price this year, particularly due to Data Plus. Though early days, customers are already seeing the benefits from Data Plus, such as vulnerability management, FedRAMP and HIPAA compliance. This is giving us a structural tailwind around both price and mix over time." Credit Suisse analyst Tim Jozovec inquired, "Bill, what advantages does your new infrastructure monitoring and APM solution offer compared to its competitors? How do you anticipate it will affect your success in the marketplace?" Bill Staples replied, "Great question. We're really thrilled about the new infrastructure experience we launched last week. It's been a journey for us as we initially acquired infrastructure monitoring a few years ago and have since evolved to an all-in-one platform. This has allowed us to take our offering to another level by providing engineers with a single view of their infrastructure, applications, services, users, and devices, and how they are all connected. We want our customers to be able to understand when something goes wrong in any layer of the stack, pinpoint where the issue is, and see the impact it has on other systems. Plus, our total cost of ownership can be 2 to 4 times less expensive than competitors. It's an amazing way to save money while getting the same deeply connected experience. Credit Suisse analyst Tim Jozovec inquired, Dave, given the past 2 years of consumption and subscription revenue numbers, can you explain why we expect a more meaningful decline in subscription revenue and higher churn rate for customers migrating away from subscription over the next 6 to 8 quarters? Dave Barter replied, Answer, the transition of our customer base has gone well and follows a pyramid structure with a top cohort, middle cohort and bottom cohort. Generally, contracts in the top cohort are larger and more material, while those in the middle cohort are 5-figure contracts. The bottom cohort consists of about 2,000 customers, of which about 1,000 may make use of the free tier. Over the next 4 to 6 quarters we will need to complete the migration process, and due to the nature of this last wave, it may behave differently than prior ones. Dave Barter replied, Tim, we believe that it is prudent to take a more conservative approach due to the potential differences in performance when dealing with these types of products. RBC Capital Markets analyst Rishi Jaluria inquired, can you discuss the potential impact of generative AI tooling on developer productivity and how your company is investing to capitalize on this trend? Bill Staples replied, Rishi, thanks for bringing up the exciting topic of generative AI. We are excited about its potential as a new secular tailwind and believe it will be transformational across all industries and segments. As you mentioned, it is driving a wave of enhanced applications and new applications that require observability. That's why we were first to market in providing monitoring for generative AI-based applications with OpenAI's GPT and also launched new Relic Grok to simplify access and speed to insights. Our business model is unique, as we monetize on both data ingest and user engagement. This positions us well to capitalize on this growth opportunity. RBC Capital Markets analyst Rishi Jaluria inquired, my question is, what efforts have you made to drive greater usage of multiple capabilities across the new Relic platform and how are you measuring that success? Bill Staples replied, good question. Our all-in-one platform model has enabled us to be the top vendor in terms of platform adoption. We removed barriers and made it easy for customers to standardize on New Relic, allowing them to access more capabilities with just one click. This product-led growth motion provides value to our customers quickly and helps us grow our revenues. Furthermore, we use customer engagement signals to inform our sales organization so they can start meaningful conversations and unlock budgets more efficiently. JMP Securities analyst Eric Suppiger inquired, can you provide an update on the rumors of private equity interest in New Relic, and can you discuss your objectives in terms of reaching market rate growth and any associated timeline? Bill Staples replied, in response to the question about rumors in the market, I can say that there are always rumors and our commitment is to act in the best interests of our company and shareholders. We are focused on our customers and continuing to execute our value creation strategy, which will be discussed further during Thursday's earnings call. I encourage everyone to join us. Dave Barter replied, Eric, our focus is on achieving profitable growth. Thursday, you'll receive an updated financial model that outlines our strategy for reaching an operating margin of 40% plus. Our current guidance points to a 14 to 15% profitability, which we feel confident in attaining. We are preparing for the transition of all customers to subscription-based consumption and believe this will set us up well for exceeding our 20% goal in the coming year. By bringing together all the pieces, we are optimistically looking forward to operating under one business model. Dave Barter replied, thank you for your question, Eric. We are looking forward to our Thursday afternoon presentation which will provide further details. We appreciate your interest in our company and we look forward to sharing more information with you then. Cohen and Company analyst Andrew Sherman inquired, Dave, could you please provide more insight into the de-risking you have done to account for the 2 headwinds and how it is reflected in your 30% consumption guidance? Dave Barter replied, that's an insightful question. We analyzed our customer cohorts in detail and we worked hard to ensure that the optimization was accurate. I can't guarantee perfection, but we invested a lot of effort into understanding how the results shifted from March to April and our current projections on what to expect going forward are the most accurate possible. Cohen and Company analyst Andrew Sherman inquired, could you provide some insight into the Q4 renewal quarter? What was the growth rate on average and how did you gain budget share? Dave Barter replied, we saw solid growth in our RPO business in the quarter. We were pleased to see commitments expand, both in terms of total and current commitments. However, there is a bit of a lag between when a customer commits and when they start to generate value from our product and we can then realize revenue. Despite this, December and March were good quarters for us, with the commercial team executing well on increasing commitments and setting us up for future growth. Dave Barter replied, thank you, Sanjit. We appreciate your question. Our quarterly earnings have been strong and we are pleased with our performance. We have seen steady growth in revenue and profitability this quarter, which is a testament to the hard work of our employees and the effectiveness of our strategies. We remain optimistic about the future and confident that our strategies will continue to drive results. Morgan Stanley analyst Theo Thun inquired, my question is, could you share more details about the usage trends seen in March and April, and how it informs your expectations for May with 1 month less in the quarter? Dave Barter replied, it's a great question. The seasonal curve unfolded as expected, with a deeper peak due to cloud optimization. Our peak actually happened in April, rather than the planned March. We anticipate that our year-over-year growth excluding migrations will be around 20% plus or minus a few points. We remain focused on migrating subscription models to consumption and achieving one business model by the end of the year. Morgan Stanley analyst Theo Thun inquired, could you provide an update on the dynamic of customers reducing usage towards the end of their contracts? Dave Barter replied, our focus is on multi-year contracts and renewing customers early to avoid any potential fluctuations in our revenue. We are taking proactive steps to ensure a more steady state of income over the next couple of quarters. Wedbush Securities analyst Hes Koujalgi inquired, can you comment on the customer experience when transitioning from subscription to consumption-based models? Specifically, what is the average drop in spend that customers initially see, and how long does it take for them to return to their original run rate? Dave Barter replied, it's a great question. In general, when customers seek to optimize and implement observability, they'll often pull back and work with our technical advisors or center of excellence to put the right instrumentation in place. This often involves extensive logging, ingesting large amounts of data, or other fixed-price arrangements. I've seen customers utilize Prometheus, expand new capabilities, and rationalize overall workloads. Unfortunately, there's no one-size-fits-all solution as the time frame and specifics vary from cohort to cohort. Wedbush Securities analyst Hes Koujalgi inquired, terms of the base? Will migration to consumption by fiscal 24 result in revenue growth being in line with consumption revenue growth in fiscal 25 and beyond, without any drag from the base? Dave Barter replied, that's right. We anticipate completing the plan in 4 to 6 quarters. We are aiming to finish it as quickly as possible, so that when we enter fiscal year 25, there won't be any headwinds from this initiative. However, it may take longer than 4 quarters. We are working diligently to make sure we meet our preferred timeline. KeyBank Capital Markets analyst Michael Turitz inquired, can you please explain the difference between your company's growth trajectory and that of your competitors given their acceleration in cloud optimization and usage growth this quarter? Bill Staples replied, in response to the question regarding cloud optimization, I'd like to provide an overview of the 3 trends that are influencing our FY 24 plan: the growth of our consumption business, the disaggregation of consumption and subscription businesses, and the macro and optimization efforts. Our strategy is to accelerate total company growth and profitability by embracing optimization efforts, simplifying and growing the consumption business, and transitioning subscription customers to consumption faster than anticipated. These 3 trends will help us drive long-term growth and profitability. Raymond James analyst Mark Cash inquired, could you provide insight into the trend of subs that are leaving and where they may be going? Additionally, are you seeing a decrease in the number of products these customers are purchasing from you? Bill Staples replied, in short, we currently have 16,000 customers with 12,000 on consumption and 4,000 in subscription. Of these 4,000, 1,000 qualify for our free tier and will remain as customers. The remaining 3,000 are in legacy models and may choose to cancel their subscription once they transition to the consumption model. We anticipate that the majority of the medium and large-sized customers will stay with us, but potentially at a lower spend or different pricing arrangement. This is all factored into our FY 24 guidance. Raymond James analyst Mark Cash inquired, could you provide an update on the growth rate of 12-month CRPO compared to a year ago and what is New Relic's typical CRPO timeline? Dave Barter replied, I'll have to confirm. My best recollection is that the metric you are referring to was up approximately 10%. We will confirm that and provide more details in our next quarterly earnings report. Dave Barter replied, for March of 2023, we anticipate a revenue of $600 million, an increase of $50 million compared to the same period in 2022.